Good afternoon. We are on video 7 and we're going to talk about pay-to-play provisions. And these are like loyalty testing for investors. Your Series B round, let's say, is struggling and you need existing investors to kind of participate and fill in the gap. And one of the investors says, we're not investing more. And they're sitting on the sidelines. So should they keep their favorable terms, you think? And their board seats, while other investors risk more capital? Pay-to-play provisions say no participate. If you don't participate, you face the consequences. So, pay-to-play is a punitive term. It's a punitive provision, a provision that punishes investors that do not participate in future funding rounds when the company needs capital. They are designed to align investor incentives and prevent free riding. Kind of different from pro rata, super pro rata, that goes the other way. These provisions are often called founder friendly, but they can create complex dynamics and unintended consequences. And you have to balance this out against, in particular, the pro rata rights. And we'll talk about it in a little bit more detail. We'll start connecting everything together. The pay-to-play provisions, they penalize investors who don't participate proportionately in future qualified financing rounds. It has to be qualified. And the basic structure would be investors who don't invest their pro rata share in future qualified rounds, they lose certain rights and their preferences. And what is it that the investors are losing? They lose anti-dilution protection. Non-participating investors, they lose protection against down rounds. If, let's say, Series C happens at a lower valuation, they don't get that conversion price adjustments that we talked about earlier in the sessions. It might affect liquidation preferences. Preferred shares convert to common stock and it loses liquidation priority. They go to the back of the line for exit proceeds. 3, you have voting rights issues. They may lose special voting rights on major company decisions. Board seats could be forfeited. Number 4, there are other protective provisions that one can think of. They can lose veto power over major corporate actions. They no longer have approval rights on budgets, on hiring. So again, it's very founder friendly. And let me give you a real world example. Let's say you have the Series A investor and you have a $10 million investment with 1x liquidation preference. And you have 20% ownership, Series A investor. Then you have a Series B that comes in and they put in $20 million. And the investor's pro rata is $4 million, or 20% of the round. This is how it all connects. But what does the investor do? They say, okay, you know what? We are only going to do $1 million instead of $4 million. 25% of pro rata. So now there are consequences. It's a pay-to-play consequence. Since the investor only participated 25% of pro rata, 75% of the preferred shares convert to common. They lose liquidation preference on converted shares. They may lose board seat or voting rights. And so what is the exit impact? So if the company, let's say they sell for $60 million with full preferred rights, there is a $10 million liquidation preference, right? But after pay-to-play conversion, only $2.5 million preference, or 25% of original, will be distributed. The remaining $7.5 million treated as common stock. Let's look at the qualified financing definition, what we talked about a few moments ago. Pay-to-play typically only applies to qualified rounds. And it has to be a minimum size, say $5 million plus. It has to be approved by board or majority investors. It has to be arm's length pricing. All of these prevent penalty for small bridge rounds. Maybe some emergency financing that will be captured by venture debt or something, but emergency financing rounds or insider recaps. So there's some participation thresholds in there. The common requirements are for 100% of pro rata, full participation is required. 75% of pro rata, it allows some flexibility. 50% of pro rata, then minimal participation will be granted. And anything below that, I mean, you might forfeit any participation right. The founder benefits, you know why? Because it encourages continued current or existing install-based investor support. It prevents investor from blocking necessary financing. It aligns the investor incentives with the company needs. And it can improve the liquidation waterfall for founders. And there are certain investor concerns that arise. It forces the additional investments, it forces them to make the additional investments rather, or they face penalties. It may punish those investors facing their own capital constraints. It can create pressure to invest in rounds that does not hit their risk threshold. It can reduce investor flexibility. So there are things that the investors are concerned about as well when you have this invoked. There are strategic considerations, down round protection. Pay to play can encourage investors to accept down rounds rather than face conversion penalties. And new investors also get a leverage, right? They know that existing investors, they face the pay to pay penalties. So what can the new investors do? They may offer lower valuations. So there are fund life cycle issues because of all of this. Late stage funds may not be able to participate due to the deployment constraints, not really a lack of confidence. And then there could be carve-outs, there could be exceptions. And some of the common exceptions, small investors below certain thresholds, that is an exception. I mean, investors who cannot legally invest more because of regulatory constraints or internal constraints. And there could be affiliate fund limitations. There could be an investor that's going through some financial distress. So these are things that come into play as well. So there are certain variations of this, all or nothing variation. You can either participate fully or lose all preferred rights. Not a good thing, but happens. There is a proportional conversion discussion. Penalty associated with proportional to participation shortfall. What does that mean? If you invest 60% of pro rata, keep 60% of the preferred rights. And then there are sunset provisions, pay to play requirements expire after a certain period or upon reaching profitability. And it's a balanced term in a contract. There are waiver rights, by the way. Board or majority investors can waive pay to play requirements for specific rounds. So in conclusion, the way I look at pay to play provisions, they can be very powerful tools for ensuring investor alignment, but they need to be balanced against legitimate reasons. And legitimate reasons insofar as investors might not participate in future rounds. The goal is encouraging support when companies need capital, not creating unfair penalties for investors that are facing external constraints. So this is where I think the partnership is so important, and the partnership with the board, with the current state of investors, look out for their interest. After all, they took the risk. It is your obligation to look out for their interest and then ensure that you are self-serving as well once their interests are met. With that said, we're going to talk about the final topic, which is more on information rights in video 8, and that should pretty much capture everything that you should look at in a term sheet. Take care. Thank you so much. I hope you found this helpful.